Hey, good morning, guys. Ken at Tortoise Capital. This is the let's see, Foundations check-in for February 4th, 2024. I'm doing a project with Phil and Griff from VWAP, and Phil was really the energy behind the connection to Chris White at Edge Raider, and we've got a nice little um, collaboration project going there. He added three of our templates to his lineup of pre-existing templates for his plants that looks at auto framer for a couple different populations of symbols, and then the sniper criteria and filters and five patterns, and auto framing with a visual layout of the chart, which is really pretty slick. And we were interested in following up with the initial good impressions that we'd gotten from the Edge Raider community. And so we're trying to figure out what kind of education or training support we could give them. And what I asked those guys to do was to say, look, the situation is probably the case that everybody feels like this little guy. He's got he's pulling hard on this wagon full of trading tools, tips, techniques, strategies that he's accumulated over time, and he's trying to move on down the road to success. Um, and meanwhile, the world just keeps spinning around and threatening to blow him off course. And he knows that he's probably got the tools in the cart that'll help him deal with and survive all that. But where to start, what to do, and the original idea from the guys was, hey, let's ask everybody to give us a list of their top 10 challenges with trading, and then uh, we can show them. We can go into the toolkit and pull out the thing that we do to address that. And I think they sent a note out, but only I think one person replied with the 10 issues. I said, hey, make it simpler, guys. Just one thing. What's one thing that is that you notice? It's either going to be a problem or it's going to be an opportunity. And 9 times out of 10, people are going to pick a problem because they have a sense of what it is that they're trying to do. But there's this damn, the world keeps getting in the way or whatever. If I could just solve that problem, then I could just go on and do what I want to do. I think it's maybe 1 out of 10 person. I don't even know if it's that many, to be honest, are habituated to looking at the world through the lens of opportunities. And where other people see problems, these guys see opportunities to solve. But my spider sense is, look, if you just asked 100 people, hey, give me the one thing that's given you the most trouble, then you end up getting a Pareto diagram, which says that the most numerous thing is going to look like this. The thing that is causing people the most problem is going to be this, and then it's this, and then it's this, and then the rest of it kind of diminishes pretty fast. So if you just get 100 people, you'll end up recreating the top 10 list Because if 100 people gave you top 10, you'd still have to do the same thing. You'd have to find the ones that were the most common. But most folks are just, as we just discovered once more, they're not, they don't have a top 10 list. They get maybe two or three things, but there's probably one thing on their mind. So start with just one thing. Take the biggest thing out of the pile. It'll give you the most bang for the buck when you fix it, and it reduces the size of the pile, creates some momentum. I don't mind the idea of notice the biggest thing in the pile right there. I like the second or the third thing. Take those things out and build up a little momentum, and maybe when you pull those two or three things out, it's easier to see the bigger thing. You can start uncovering more about it when you take things out of the pile. So I don't know. Anyway, I really like that image, and Chris Wydu's a really nice guy. Um, he calls himself the chief data wrangler at at his business, which I think is pretty slick. And this is he. All he did was just took the words that I sent. I sent them a prompt that said, "I want you to picture a guy." Let's see, where was it? Yeah, use an image of a frustrated, uncertain person trying to walk a path to the land of milk and honey, but there's a tornado of information swirling around and blocking their path, and they're pulling on an enormous wood cart filled to overflowing with useful tools that are not being used, just transported, right? And so that's what the AI came up with, and I really like it. You got to remember to say that. So that's kind of where, in a nutshell, that's really been my experience with the these check-ins and the Q&A sessions. Is that there's probably some iceberg effect where you can see the visible thing here, but underneath there's these deep roots and troublesome things swirling around. Well, just get the thing that is on the surface. It doesn't mean that if we solve this thing up here, that all of this goes away. It just means that we've lopped it off, and now that lightens the load, and the next little thing will pop up. And so you just keep whacking away at the thing that you can see. And meanwhile, as you study the things that are popping up, you might be able to infer some of the foundational things down in the roots. So, I mean, I really do think that uh, we need to harness both of the aspects. This is, I think, kind of the rational, and this is the story thinking. If you engage in story thinking, you end up seeing the connections to the particular separate things that are going on that manifest as problems, and you end up seeing maybe there is some kind of taproot, and that what looks like separate mangrove trees are really all connected at the root level. Story thinking helps us see ahead to those things. Now, if you take this whole thing and rotate it 90 degrees, you end up seeing, you the little walking man, you start seeing these things on your visual display, but really what's behind that is that taproot or something. And what we're gonna and all we can see when we are thinking linearly is the isolate and affect it. So I'm gonna take that one. But story thinking ends up seeing this whole thing as a journey, and might be able to help us see, the pathway to the root. And so what is the thing that allows us to get from these individual strands to the thing that's causing at the foundational level? I think that's stories. And this work I'm starting to do on hypnosis is and mindscaping and learning this technique is going to allow us to access that fast forward and fly over the immediate. This is really time and space, or space time allows us to go immediately to the root without neglecting these things, but these are just become handholds for how to construct a pathway, like a knotted hand line that allow us to go from the thing down into the roots, then address that one, and then it affects all of those things that are on our visual display. So that's kind of what's on my mind. Um, Jonathan's question concerned the VWAP and how I use it. And, so to that end, let me, there was, where did I put it? On Patreon, but also in the courseware, I added, yeah, this one. So this is an essay on market profile and the VWAP, unveiling professional traders' tools and resources for advanced market analysis. And it gives some background information about the market profile. Steedlemeyer created it in the 80s. It's used to identify value areas and price action over a specific time frame, offers insights to market structure and trading behaviors. I like it because it regards the market as a battleground of sellers and buyers. I really do see it as a tug of war. And when you graph their activity, it creates a bell-shaped curve in the form of a normal distribution. And so this is the shape of the distribution of, in TC 2000, this is called volume at price. And so what that does is it takes where volume is normally expressed as volume through time, which tells you how much volume was transacted between, time A and time B. And then it would give you a little stack and you could see how much volume. Volume at price simply takes the entire time frame that's on display and then shows you in a histogram where that volume is transacted. So this very top level of price, only it produced that much volume and center of mass right up in here. So not much volume at all. But if you take a look at these next bars, you can see that most of the volume today, the most active price levels were these. So that's where the most number of shares are being exchanged. Now, it consists of two bars in TC 2000. This one here in green shows how much volume was transacted in the positive space, meaning That's how many shares were exchanged hitting the asking price. So this is optimistic volume, meaning they're willing to pay up. And then this amount of volume uh, is how much volume was transacted hitting the bid, meaning this is pessimistic volume, meaning that the sellers were willing to come down from their ask and hit the bid. But taken together, this is how much volume was transacted in that cluster. The most volume was transacted in here. So there's a ton of volume that was hit at those two prices. So one of the ways that you can use this uh, volume at price on TC2000 is to be able to get a shape of where the price action occurred. Looking for where's the day marker on that one? I think this was the gap. So well, this was yesterday's price action at close. So that's now notice that's where the VWAP ended up. So this thing on the side or volume at price is is the guts of what's called the market profile. Now there's a whole theory of the market profile, which is contained in this further on in this essay. And there's some, I mean, entire books have been written on that. And I think it's pretty sensible. It's pretty popular in certain areas. And so I think it's important to know the ideas behind it, even if you're not necessarily a follower of it. But one of the ideas behind the market profile is that on any given day, uh, the highest peak, and we'll just call it right in here, is called the point of control. And the upper limit of the day is here, and the lower limit was down here. And that means going forward, this price, the point of control, is going to act like a giant magnet that everything is going to come back to. Now, if I rotated this 90 degrees, I'd end up getting something like some kind of distribution. So if you go to wherever the point of control is, that will be the thing that has the most volume. And then if this was yesterday's, so if this is price and this is volume and this is low price and that's high price, this point of control is the price that everything comes back to today. And the idea is that if you were watching the live trading and the prices, you'd see this thing getting taller and taller as prices being or shares are being exchanged at that price. And then when you get a profile of the day and you rotate that back 90 degrees, you would see there was the high and there was the low. And here's the point of control. Tomorrow, if we get an orderly opening, it opens inside that daily range. The most likely move is back towards fair value. This point of control then becomes the idea of fair value. And we're not allowed to be surprised if tomorrow, if price opens inside this or even outside of it, that uh, we expect price to move back to this magnet, this point of control. And so one of the ways to play the gap is, look, if it does gap up here tomorrow, and I know that's where my point of control is, what I'm looking for is when does this thing start to make that kind of a move? And then how much of that move after the gap represents an actionable signal to make this trade? If I, well, if I know what my MMRB is, and I see a high of the day, this thing gaps to here and then runs up to here, and then maybe it's running this way, I can actually hang this MMRB from the current high of the day, and when it's falling, if it when it moves a whole MMRB from the high of the day, and if I have two of those, that's a frameable trade right from the open. Check or hold. So if it gaps to here and peaks right here, and then it falls an MMRB from the current high of the day, and if I have two MMRBs back to yesterday's point of control, then I have a 2-to-1 trade frame, and I can use that on the gap. So now if I take that information and I sort by gap percentage from my list of prepared tradables, I can add this to last week's lesson and say, look, right from the open, I'm interested in the ones that have the biggest gap up and the biggest gap down, because that's where the most action is going to be right from the get-go. And I can go to 3-minute charts or even 1-minute charts, and I can start playing this gap fade or gap run. Because sometimes this thing might just go. What if this thing gaps to here and then moves a MMRB from there, and off it goes? This might be one of those days where there was enough news that the thing is just going to go. But I'm always ready for a big gap up. It runs and then reverses all the way back to point of control. So that's one way that we can use the idea of the VWAP and the point of control and market profile combined with our understanding of gap statistics, and then combined with our strategy of preparing a certain number of um, symbols to be ready to trade them tomorrow, we can combine that into an opening range strategy. Now, the next thing I want to talk about is the VWAP and the close. So it is almost always the case, 80% of the time, most of the time, that the VWAP from yesterday is equal to the close. That was where yesterday's VWAP ended up. That's also exactly where the price ended up, that they were the same thing. There is a convergence 80% of the time of uh, price and the VWAP. Things come home to the VWAP. And when I say 80% of the time in that language, I'm using the Pareto idea of most of the time generically. So that's 80 plus or minus. But here's a case on exactly the thing that I'm showing you of the SPY, where the VWAP started off at the open with a ton of volume, and then price action all day stayed north of that. And meanwhile, the VWAP just keeps grinding higher and higher. So the way this dynamic VWAP is computed intraday is you take all the shares so far and you multiply the share price times volume to give you a weighted price. And then you you sum all of those and you divide by the number of shares, and that gives you the volume weighted average price. So this is a rolling average that each time that I get new trades, the number of shares and whatever price they're being traded at gets added into this basket, this wagon of price being carried forward. And so you end up getting a continuous a continuous price. Now, when you see where it started and where it finished, I mean, obviously this was a strong up day, but what you notice is that it was continuous buying with enough volume to keep lifting the price higher. So each new sale that you're making is carrying a larger and larger load of all the previous shares, and yet it was still able to pull price higher. That's pretty amazing. So that was a lot of volume being transacted in this region to be able to pull the VWAP from here all the way up to there. Now, how is why does it matter where price was transacted during the day to what the volume weighted average price was? Well, in the world of institutional trading, between a client and their broker, now the broker is quite often a bank. An institutional client. Now, who are those guys? They're going to be guys like pension funds, hedge funds, anybody with a lot of money. And what they can do is they can hire the trading house at their bank of choice and say, look, we want you to be our agent in the market because you have an amazing professional trading room. So we're just going to hire you to conduct business for us occasionally. Like we don't want to create and duplicate your trading room. Rather than try to beat you, we're just going to join you. So we're going to give you what we want to do is we want to buy a bunch of Coca-Cola to add to our portfolio because they're looking at their portfolio and they're saying, you know, what we're missing in here is we need some Coca-Cola and we've only got this much Coke, so to speak. That's how much they have, and they want to add that much. So they want to add to their and what they want to do is they want to take about 2 weeks. Over the next 2 weeks, they want to add 5 million shares or something, a large number. And so if the rest of the world is out there of institutional, and they say, hey, everybody, these all these guys over here are saying, hey, everybody, I just heard that old client 123 over here wants to add uh, $500 million worth of Coke to their portfolio. They are a motivated buyer. So what we can do is we can use our shares of Coca-Cola and raise the price and make these guys pay more for the Coca-Cola that they want. So if we had that information, we could manipulate the price and 5 million shares at whatever it's trading at. I think it's, imagine it was 60 or something. That's 300 or 500 million dollars worth of motivated buyer. Well, then we can take advantage of it. We see you can't just go into the market and say, "Hey, I want to buy 5 million shares." That would it would drive the price up like that. and then they'd sell it to you way up here. And then if nobody else wanted to buy up here, it would immediately fall back to the current price. And then you, the biggest institutional client, would be getting murdered just because of your size. Well, these guys don't want that. So they say, look at broker, I'm going to pay you a bunch of money to get me the best price that you can for 5 million shares. And I just need you to complete that transaction over the next 2 weeks. And now here's what we're going to do. I'm going to give you a fee to do that. Plus, I'm going to give you an incentive to do that work. And I'm going to let you say, let's pretend you say, I'm going to let you keep a half of whatever price improvement that you can negotiate with your trading skills over the next 2 weeks. I know that you guys are smart enough to go look at the buying and selling, and you're going to find out ways to drive the price down to here so you can buy a bunch here. And then when people, so you're going to sell 10 shares, but you're going to buy 1,000 shares or whatever you're going to need to do tactically to manipulate this market so that you can buy a lot of things down here instead of way up there. And you got 2 weeks to do that. And so when this broker is executing that order, the way they settle up is the baseline is, look, the volume weighted average price is where most people bought the most number of shares. So that's the unskilled, naive average price. And a guy says, look, if I didn't spend this extra money and give you an incentive pay, I could just buy it at the VWAP, I guess. I'd be happy to just get it at the VWAP. So what I'm going to give you is one half of the gains if you can buy it below the VWAP, and you don't get any incentive if it's above the VWAP. And we're going to take a look at all of your buying and selling over this entire 2 week period. And then if you are able to execute down in here for all the purchases on that, then I'm going to give you half of that's going to be yours and half of it's going to be mine. And we'll use this extra gain to help pay the fee. Now, we tell them, if you're able, so that means if you are successful as this broker, dealer, and bank and trading firm, the traders, if you're successful at buying below the VWAP routinely, I'm going to give you all the business that I have. And you're going to be able to use my money to gain money at no risk to you. You're just using skill as a trader to generate income from your proficiency. So now these guys have a vested interest in improving their tactical trading with algorithms and machine learning and high speed internet and direct cabling in and using their cleverness. And they can use their lower rate of transaction costs to do micro trading and rapid intraday trading to defeat the algorithms of other institutional traders. That's who is in the competition intraday, and that's why it's hard to beat those guys on micro trading unless you are invested in the same kind of infrastructure, machine learning, and bulletproof code. But all of that trading, and about 70% of the intraday volume in the large cap stocks, is being done by guys that are doing this micro trading. And the path that they take, the footprints that they leave, are in price, and the accumulated pathway of the net result of all their action is this VWAP. Now, what's happening during the day is a lot of leverage is being applied in the futures markets uh, and in the equity markets to be able to buy and sell much larger positions than owning the full position. So when the market is open, this price is being adjusted on the fly dynamically, almost instantaneously. So the amount of risk is equal to how much does the price vary in really short periods of time. And you can construct trading rules that allow you to get in and out really fast. So you're not at as much risk as when you get to the overnight trade, which is, look, here's when the market is open for 6.5 hours. And then here's tomorrow when it's open for 6.5 hours, but it's closed for 17.5 hours. And in that 17.5 hours, all the news can happen, and then all the trading activity that can happen after hours in the futures and Forex markets. And all of this stuff gets processed. And if it was all positive, all that activity now indicates that the new fair value is way up here when it closed way down here. And so that's where the gap comes from, is the immediately market opens and it's now trading at the new price level as determined by the market participants who are buying and selling, who are making their decisions based on news and activity that occurs when the market is closed. So you're at the mercy of the gap. And how big can that be? Large, larger than average daily ranges. The gap stat tells us what the statistical performance of those gaps are. And this is a distribution with a very fat tail in both directions. It's not normally distributed. It is non-normal. And you get these fat tails that'll murder you. Well, if you're living in a world in which the risk is to these fat tail events for these gaps, then if I'm a bank and I'm lending you money to hold a leveraged position overnight, you got to pay me a much higher rate on that loan when the market is closed than when it's open, because when it's open, the price is being adjusted quickly, so I can loan you at a certain rate. But if I'm going to charge you the overnight rate, it's going to be much larger because of the much larger risk, because of the longer period of time in which news and activity can take place. So in my margin account, I might be able to have 10 times the size of the position during the times when the market is open compared to how much I have to pay when the market is closed. And so when the close is coming, I'm under time pressure to exit my positions so that I don't have to carry that excess risk overnight. Not only am I paying a larger dollar share for the loan, I'm also, if there is a big gap, I'm getting murdered in the price and I can't do anything about it until the market opens. If there's a big gap in either direction and I'm on the wrong side of that, I'm going to get obliterated. And I'm going to have to pay a higher loan rate to do that. And over time, that's a losing proposition. So during the day, after the opening 30 minutes, I have some time when it's really optimal to start using leverage to push the market, whatever, or the market will move in the direction I'm going. But if I think it's going up, I can start using leverage to buy. Then the fact that there's leverage buying goes on makes the sellers retreat, as a lot of buyers are trying to buy it with leverage. They just say, okay, come and get me. And so that's where the market profile starts telling you where they're hitting the bid and the ask and at what price they're being transacted. And then you start seeing the statistics and you realize there's a lot of shares being exchanged up in here. And that becomes a new price level of support and resistance where a lot of trades are being executed. Down here, there was not a lot of volume. And there was a bunch of guys that were willing to pay whatever the asking price was. No, it's the same thing. It works the same for both. It works better the more liquid the thing is because there's more people buying and selling. But it's great for indexes. It's also great for large cap stocks and ETFs. And ETFs consisting of large cap stocks, like the S&P 5, like SPY, DIA. Well, all of the members of DIA have single stock futures, so this all applies to trading with leverage on individual stocks as well. But one of the things that you can figure out is that you can look directly at the market profile and see where are the support and resistance levels from today, and now those become support and resistance levels for tomorrow. Here's where the market closed today, and the next support and resistance levels are here, and also where the VWAP was. Now, let me get back to the idea of the VWAP as a magnet. The idea is that price and the VWAP start off at the same location all day, and then as this comes running up here, and this is new volume being transacted, when you added that to how much shares were transacted down here, the VWAP only raised a little bit. So this is guys that were getting in front of early buying, and they drove price up to here, but the actual VWAP is down there. So if I am that guy who is the broker trying to make money on this, I stop buying it there because I'm thinking maybe if all the buying dries up, price is going to come back and then I can buy it down here. So that buyer disappears. He got his little burst and that burst drove it up and now it's hanging here. He wants to see. Oh crap, it keeps going up. Maybe I have to buy some more because I don't know how it's going to go. Or maybe he just says, no, I'm going to wait. Well, what happens is there's some kind of tipping point here in time that says all of these guys that are buying massive quantities with leverage at some point have to start unwinding their positions. So if I was a buyer all the way up here and I see price up in this region, I say, you know what? There's going to come some selling pressure and guys they want to get rid of their volume up here because that's going to give them excess cash because they know they're going to be held to the standard of whatever the VWAP was for the day. That's what the price for today is going to be. And so if I look at this, I say, everybody, if I'm that broker, all of the shares that I bought down in these price levels is cash in my pocket. And any shares that I bought and I'm still holding up here is I'm not getting paid. That's eating away at my profits as a trader. So somewhere in the afternoon, there's a tipping point when instead of the optimistic buying, guys are trying to hurry up and sell because price is going to converge back to the VWAP. Now, most of the time, this price is going to come back to here. Here's a case where price stayed up here and there's still a little bit of a discount or a premium that's being paid here to hold it overnight. Why? All the guys that bought it up in this region are still willing to hold it here, even though this was the VWAP, because they think on Monday there's going to be a bunch of buying pressure on SPY when all of the weekend people look at all-time high was hit. Hurry up, we better buy it before it goes higher. That's very optimistic. And so it would not be surprising to see price which closed here gap even higher up to there for a brief moment in time. And that means this is a justified risk because they're holding out because of, uh, but what would cause the price to gap up? You'd have to convince all of the sellers who own inventory who have to satisfy that need. That, look, in the order book, there's a bunch of guys that are going to buy at open, locked in into the order book. So these guys are saying, well, we'll just jack the price way higher, sell a bunch of inventory to them, and then when all that buying disappears, price will fade back to the close, and then they're going to be buying with leverage, and then they're going to panic and start selling, and we will sell it to them at this level, and we'll just come back in and buy it back at this level and reconstitute our inventory, and we'll make that money. So who do you think's doing that? All the brokers and the professional traders are manipulating the gap and trading and fading the gap, and they can use the closing price and the VWAP as two anchor points around which price can revert. In fact, they're also going to use the point of control as an important price. They know that if price gaps up above today's high, that the most likely case is for this thing to come back to the point of control and then determine which way it's going to go. That would make this a compound critical state. Well, how can we use that intraday? If we know that that's the dynamic that's always happening at around the close and at the open, we can use the intraday information of the VWAP to say, look, when I get leg one, pause, leg two, pause, leg three, pause, and here's now the Bollinger Band mean, and that happens to be at the peak of the RL10, I can treat that as an important trigger point, and I can use this as a secondary trigger point for a collapsing dragon. And if this thing rolls over, I can put a risk box right here. And my target is a return to the VWAP because I know at the end of the day, if that's where the VWAP is going to be, price has in this region has to converge most of the time back to the VWAP so the guys can settle up their order books and be held accountable for the VWAP. So if all of this buying pressure didn't happen, it would have been normal for this price to come back to here and then a bunch of price transacting in this region or down in here in order for the VWAP to stabilize and just stay right here. Instead, what happened was there was enough buying pressure in here to drive the VWAP up to here. Why? Because there's evidence of optimism and thinking about next week and going on to greater and greater glory. That's when you see price closes above the VWAP, I generally interpret that as an optimistic feeling that people were willing to hold the premium overnight because of an anticipation of increased gains. Now, why do guys have that opinion? Why do people have opinions about where the price can go? There's as many reasons as there are people, fundamental and technical reasons. I don't care. I'm just trying to decide where the risk is. Okay? So intraday, I can use this as a giant magnet and say that at some point after the morning move, there are going to be these urges to come back to the VWAP. And if that introduced some panic selling like that, it wouldn't surprise me to see it come all the way back to the VWAP. And now what I can do is I can measure all of these maximum excursions and I can put the statistics on that. And I can say if that was as much energy with leverage as there was to move price away from the VWAP on the upside, I'm not allowed to be surprised that if all those traders got on the other side, they could move it this far. So now this move that came down to here, I'm not allowed to be surprised if it came and hit the VWAP. And then on the next leg, I'm not surprised if it's allowed to come all the way back to where it closed yesterday, which was the point of control anyhow. And this might have all just been fake stat and optimism, and then it collapses and comes all the way back to here. So I always need to keep that in mind where yesterday's high and yesterday's closing price and where yesterday's point of control was and where today's point of control was. Those all become weights. Now, that is very similar to the principle that we use about uh, the pinch that happens when the RL10 and the RL30 in black and the RL90 in green are all co-located with the RL270 in a really nice, uh, some kind of range compression. So if I have range compression and all four of the regression lines are tucked in, that's going to remain sideways until traders with the RL10 run it up to a new high, and then they can't take it any higher. And then the RL10 starts to roll over, and then that becomes the statistically significant max price, the statistical max price, even though price itself, the bars may have gone up a little bit higher. When the R10 rolls over in a rapid fire, well, the R30 starts moving up as well, but it's a little bit slower because it has extra baggage to carry until it rolls over. And then where the R10 crosses the RL30, what do we have at that location? What do we have happening right here? That's a quiz. We have a P1, yeah. P1 RLXD. Now, for it to be a P1, this had to be an explosive move, and it had to leave the 30-period Bollinger Band river behind. So when you have this kind of range compression, then you also have a sideways river. And the river in the Bollinger Band in the middle is very tightly compressed. And then suddenly you get this burst of buying pressure, bang, and then rolls over. And then when it crosses when the 30 period leaves the river, we have the beginning of trending behavior. And then that thing rolls up. And then that's what makes this a P1 in RLXD. Because while this is happening, the simple moving average of the 30, which is this one, the river slowly follows, and then the Bollinger Band comes up like it's supposed to. And there's your river. And then here's your Bollinger Band mean in the center. That's the new normal. And because you had such an extraordinary price action here, this burst of new buying pressure that came out of nowhere. Who was that? That was those institutional traders with big bags of money that wanted to buy this thing, which had refused to fail. And they're going to try to sneak in and buy as much as they can. but the sellers are pretty savvy, and so they push the price higher to make them pay at a premium, so they get a burst, and now all of the buyers disappear and this thing rolls over and it comes back to normal. We get the RLXD, and now all of a sudden, the most normal move is a return to the new mean, which is now the middle of the river. So when I'm looking at my MMRBs and whatnot, how much do I give back? I'm really saying, look, the reason to exit there is because I'm going to protect against 2 or 3 additional units of loss when it comes all the way back to the rising middle of the river. But if it doesn't come back to the river, if instead this price comes to here and then reverts higher, and meanwhile the river is going to continue to rise, now what I have is the ability to put what kind of pattern would we expect? If I ended up buying a Z3 pinch breakout here and I made this trade and I exited here, and then price continued down and then reversed higher, and the R10 reversed here, and this was the peak of the RL10, what would I call this trade right there? What kind of pattern is that? We'd think of that as the COTA 2. Yes, we would. We're buying we're buying strength on a dip. Now, usually you've heard me say that in conjunction with an SSC move, but it's also a COTA 2 if this was a Z3 pinch or a super pinch and you got a breakout and you got a successful move up, which pulled back a measured distance and then made a higher low based on the turning point in the RL30 or the RL10, and that's what gives you the COTA 2. So my point is that all of this is geared intraday to the notion of what is price doing up in here, but also, more importantly, what is the VWAP saying, the true fair value at the end of the day, the fair value in order to adjudicate all of that buying and selling for fee and profit and incentive pay, the fair value each day was the VWAP. And so if I was a buyer today, I could compute my own weighted average of prices. So let's say I bought a total of 4,000 shares for my client in 4 lots of 1,000. And I paid 50, 51, 51, and 52. Well, my average price is 51. And if the VWAP for the day was 52, if the VWAP for the whole symbol was 52 and my personal VWAP was 51, my trading activity was savvy and I earned $1 on 4,000 shares. That's a price improvement of $4,000. And my deal with my client is he gets 2,000 and I get 2,000. And he's going to use the 2,000 he gained to start paying my broker's fee, and I'm going to keep the 2,000 incentive pay. And then maybe I negotiate a better deal with him that once I have earned him back his fee, maybe I keep more of the incentive, but I can negotiate that. If I'm a really good trader, I can drive a harder bargain on what my incentive pay for handling your volume instead of the other guy's volume is. You see how that starts working now, where skill in trading comes from? Skill in trading comes from the ability intraday to make those kinds of you know what's really good at doing that? Machine learning and algorithms and rules. and adaptive rule sets that can trade in both directions without a directional bias and can take advantage of local anomalies in price. All right, so there was a question in there. I want to the RL90 topping out with Z scores and the RL30 turning up. Can we expect a pullback? Is that well? I don't want you. There's always a pullback as possible. Remember that we can't see into the black box of what those guys are going to do. I cannot use statistics to predict a pullback. What I can say is that it wouldn't be surprising to have a pullback because inside that black box, I don't know what's going on inside it. But what I can do is I can see the evidence that it leaves. And what I can say is from my, let's see, where's my, now when I go to I go to this chart on the weekend and the daily report, what I can say is that the the improvement in the RL90's slope as measured by statistics over this 90-day period, the RL90 is so steeply up that that is extraordinary. This is almost never seen. 1 in 1,000. And the fact that the 30 did this and pulled back, this little period here, it wasn't really failing, it was just going sideways. But compared to the previous slope, was up so much that the sideways slope and the z-score brings it back into normal considerations. But because it did not fail back to previous support, it's actually starting to get better. So if I look at this, that's the RL30 slope. And I'm going to draw this in green because that's the color I use on the chart. The RL90 slope is just going. What you actually have is it looks like a Kata 2 kind of a style. The thing is starting to move. But both of those are so steeply up that you wonder how many more buyers, this is the actual price. That's what price is doing. How much cash is still on the sidelines that could keep buying this thing at all-time highs? Who are those people? If I take a look at the first, the second, the third, the fourth, and the fifth mouse, the first mouse was probably buying way back here and is continuing. Second mouse was buying in here. Third mouse was in here. This is probably fourth mouse. Uh, How many of these guys are left with that without money committed to the S&P that haven't bought it yet? How many guys are still out there that are going to now decide, let me sell these laggards in the global markets and then come over to buy the S&P at these all-time new highs? How many of those guys are left? So you might start thinking, all the guys that have used leverage are in, all of the guys who were on the sidelines use their cash. How many guys are selling other positions in other indexes to come over and trade here? How many guys are reducing their Forex accounts in order to come buy the S&P 500? So you just wonder how many buyers are left when you're getting to these statistical improbabilities up here. The probability of some correction of 3 3%, 5%, 8%, 10%, 15%, 20% sell-off. Once this thing starts rolling over and price starts to fail, how far does it go for just a normal sell-off before it resumes again? That's the big discussion for longer term traders who it takes them a long time for um, for holding positions and changing positions, because if they just made huge moves, it would change the price. So they're trying to sneak their positions under cover of darkness, the stealth trading. And that's why the intraday trading of buying and selling is so volatile, is because guys are trying to determine each large lot buying and selling is a signal, possibly, about a longer term commitment to price action. And they're trying to figure out what is the what is that telling me about long-term fair value of the market when there's a lot of volume being transacted at this price. There's a bunch of guys, and it's at an all-time high. How smart are the guys that are buying? If that's large lots on a large cap stock, and that's a lot of money being dumped into this to buy it at this level, evidently somebody with a lot of money thinks price is going up to here. And then the guys that are selling them that are saying those guys are wrong. I think it's more likely to go back to here. Which one of those guys with big deep pockets is right? I don't know. All I know is that if it falls a certain distance, I can set up a 2-to-1 this way because it looks like that is winning. Or if it keeps breaking out, I can just raising my stop and keep my money on the winners, but be ready, but not fall in love with that position, but be ready to respect the stop rules that allow me to give it a certain amount of room to run. And then if it gets high enough, maybe I can trade that on the short side. But I would actually rather trade the things that are already failing on the short side rather than trying to find the strongest sector and the strongest market and then go short that. I'd just rather go see the thing that's failing. Because if the S&P started to fail, there are other things that are correlated but weaker that'll start to fall in sympathy, and that's a safer short. But if I wanted to simplify my life, maybe I would just be an SPY trader and just buy and sell based on its gains and losses and just concentrate on that market. There's a lot of guys that do that, and also the small caps and the mid caps and the dollar. That's, pick your market. There's a lot of markets to choose from, and there's some advantages to diversification and some advantages to concentration. And you got to find the thing that works for you. But it turns out that this analysis of SPY gives us a lot of insight into all of the things that are strongly correlated to the S&P, like US large caps, like DIA, like individual symbols like Microsoft and Intel and the tech sector and all that shit. So my point is, this is room for cautious optimism, but man, this is how far. When it rolled over last time, and it wasn't even that high, it came down 1, 2, all the way down to here. So how far did that normal sell-off get to? It fell as low as actually down to here. It came all the way down to 410 from a peak of 460. That means it lost $50 on 460, which is 1/9, which is about an 11% sell-off from peak to trough. And it made an 11% gain, and it made another. Let's see, this went from 460 to 490. It gained 30, so this was like plus 6%, and that was plus 11%. So that's been a 20% move. Is that tradable for you? Well, depending on your minimum manageable risk box and position size, that's where gains come from. So my point on all this is I want to get back to the idea of the VWAP, just in conclusion. For the short-term traders that are trying to minimize the overnight risk, um, let me go down to the 1 minute chart here on Cliff. So here was a time where Cliff, which the previous day had been strongly up, here was a day where Cliff did this. This was Thursday. Cliff bottomed out after the harsh Fed sell-off, and then it opened here, and it gave a COTA 2 entry, and it crossed the VWAP. And there's your turning point in the Dragon and the RL10 and the 30. And so if you look at our hybrid, there was all kinds of entries in here. And then it did not fail right here. Like this was a point where it had cleared resistance, and that's a reasonable profit to protect. And it starts to stall, but it didn't come down here. It took another leg up, and then in the afternoon, instead at lunchtime, instead of coming back to the VWAP, look at the jump in the VWAP. There was a ton of volume being transacted here. It came all the way out to here. And that drove it to here and to here and to here. And now here was the peak of the day right after lunch. And then notice where the VWAP was. This was not a lot of volume because the VWAP only came to here. That's going to be the fair market price at the end of the day. So now look what price did from here. It collapsed one. It tried to make a COTA 2 recovery. It didn't. It rolled over. And now look what happens. You have a turning point in the R10 and another turning point in the R10. What does that make this? What is that? Collapsing dragon. What is this? COTA 2 supported fall crossing or a pocket entry. That's the aggressive entry. This is the no-brainer. What is this? The price target for the failed trade. What is this? That's a second position on a VWAP fail. If this is how far they could move it away from the VWAP, this is how far they could move it across the VWAP. It actually came about almost half away, but here it couldn't go any further. So what does that make this? SSC. SSC because you have lower lows. And this is the harsh winter. Harsh winter. This is now a new SSC. Now you could say maybe this is a COTA 2 because this is higher than those. But I'll tell you what, when this thing collapses all the way, was this far above the VWAP and then fell below the VWAP and came that way? Dude, that was a harsh winter. Check or hold. And then in the amount of time that's left during the day, there's only 90 minutes left in this session. So this is a tactical move, one leg and then it failed, one leg and it failed, and then some shenanigans in the afternoon, but it came back and finished right at the VWAP. It closed right at the VWAP, which is, and this stayed stable all day. So you know that this was just this was unloading all of those leverage positions, And then this was just tactical noise. And that's why I don't trade in the last hour or half hour, because it just slops around the VWAP and there's no follow through because all the leverage is gone. And there's many fewer buyers and sellers. So after the morning 30 minutes, there's about 2 hours of a big move. There's a lunchtime compression, and then a return to the VWAP is not surprising at all. Jonathan, have I answered your question? Now,
Uh,
look what happened the next day. It closed here, but now it gapped and sold off, and here's the VWAP. And now all of this buying, you start seeing the rising VWAP. It gets to here and starts to roll over. Hey, good enough is good enough. It couldn't even break out higher. So I'm preserving my gains from all of this move right here. And now I'm looking at a return to the VWAP is not surprising. So now when I'm trading on Friday, I can see how much buying pressure there was. And now watch what happens today. Now compare price to the VWAP intraday. There's still some buying pressure, but it's being capped by yesterday's peak. Check or hold. Now when the VWAP breaks, that's significant. Here is where the VWAP held. Now this becomes kata 2 because it's holding. It didn't even go as far as this touched the VWAP. This didn't. Notice how the RL30 is changing. This is an owl. This was an SSC. This was a kata 2 and an owl, and you can still get that trade. Hey, if you're buying at 2040 and it gets to 2060 and you get to keep 10 cents per share, and the R10 in Cliff is 9 cents, that's 1 R. If you want an R, that's where R comes from. Look at this move now in terms of from the peak to the VWAP to the low. So if I could get short here at 2050 and I can trade it down to 20, that's a 5 R trade intraday in 1 hour. Hey, what if I could only get 2 R in 1 hour? Would you be happy with 40% efficiency in an hour? The answer should be yes. Yes, I am. And morning hooks, when they reverse at almost the same level that it held yesterday, and this crosses back above the VWAP and the PSAR flip, and now I can get, what would I call this entry in here? Big gap down and reversal. That's probably an SSC. The WMB3 would also be working inside there. And now if this thing gets through the Bollinger Band mean, good. I'm at no lose plus dinner for 2. Where do I expect it to start stalling? The same place it stalled yesterday. So if I'm long from here and it gets through the VWAP and this thing starts coming up to here, what am I ready to do? I'm ready to cash, but it didn't. It didn't. It went all the way through to here. And I see it starting to roll over at the same level yesterday. There was a lid on this thing. And yesterday it failed hard. So if this starts failing, I'm not sticking around. I'm going to get out here and I'm going to make my trade from 2015 to 2045. That's plus 30 on a .09. That's a 3 R trade. From here to here is a 3R trade. So now suddenly when all of this double bottom holds and it's holding support above the VWAP, you know how often I'll take that trade right there? All day, every day, all of them. Because it's the R30 has turned. That makes it an owl entry. I got a double bottom. I have a clear signal of where it's going to fail. If it fails through the VWAP, I'm entitled to believe it could come to here. There's no support in here at all until it gets down to here. So if the VWAP breaks, I think it's coming to here, which is this. Check or hold. So the VWAP acts like a magnet. It is similar to the idea of the regression line fractal framework. So in the afternoon, a reversion to the VWAP is the least surprising. I take the size of the favorable excursion, I project it to the downside and say, I'm not surprised if it goes that far, especially when it's confirmed by that kind of price action. Now I have a reasonable bracket. Now, how big is my MMRB? That tells me if I have enough room inside this channel to start setting up 2 and 3 to 1 trades. Check or hold. And now that's the same idea as using the regression lines on any time frame. What I'm looking for there is the RL270, which usually does not vary much at all, as the long-term fair value. It works the same way as the VWAP does, as a giant magnet. And then I look to see, especially during compressions, hey, here was a time when the RL10 was co-located. So they both agreed, the traders and the holders both agreed at this moment that that was the fair value. And the traders ran it all the way up to here and it started to roll over. I can say, okay, that was the peak of the trader's power to move it away from the holder. And so if I can set up a box like this, there's a 6-to-1 return to long-term fair value. What if that was just a false breakout? And then what I can do is I have the RL30 and the RL90 acting as intermediate price levels. When the RL10 crosses, I get an RLXD. That's sort of an official announcement that maybe that was maybe that's all that there was. Maybe that was the excessive move. And then what price would tell me that the original move is still underway? Like that was a good move. Maybe that's just leg one. It would be a breakout above the peak of the RL10, which would be an emerging dragon. So if this thing does not fail, but reverses now in this little yellow zone in here, when this thing reverses higher, this is where I'm getting the kata twos because of strong move, kata two. The emerging dragon is confirmation. Check or hold? Okay. Uh, Now, when if this is on Patreon, the VWAP and the market profile essay. and it's also in the foundations course now, and it's also in your small group in the small group coaching for some of you. So this is some of the language of the market profile, concept and origin, structural components, interpretation. Here's a picture from today's essay. Now I want you to notice how important these look back periods are. It held above the 10-day low. Look, there's a kata 2. Look how smart that is. Jesus H. Christ. You got the 10-day low holding. This little sell-off made a 5-day low because there's the 5-day. But it held. And then it made a higher low. And now look at the VWAP. You got to agree with me that this is oversold. And it just made a kata 2 and crossed a VWAP. Friends, Romans, and countrymen, you got to buy that. And that's your risk. And if it breaks above this, this is free and clear. So that is a strong confirmation signal or a second position. If it makes it through here, where's the next place it's going to stall? Notice how it started to stall. When it breaks through there, what's this? Emerging dragon. Because it broke through a triple top. That's a triple lock door and it broke through and it gave you another big chunk and now it's here. And here's the VWAP. And here is the closing price. And here is the 10-day and 30-day high, and it's also the all-time high. So if price opens and at any time tomorrow gets above this price level, that's all-time high and off we go. No resistance. What I want you to see is the importance of these checkpoints. These are the places where you're climbing that mountain and you're getting information and you're locking in safety by tapping in protection. And you're using that to make calibrated moves. And all of these moves here, I can refer to these price points. Look at these rising lows. And when this broke, there was a momentary burst. It could only get to here, but then it couldn't get any higher. And then it gapped down to here. And instead of recovering, it failed and it failed all the way to here, all the way back to it. So these price points are trigger areas that market profile can show you where price was being transacted at in large volume. But it allows you to build these little test levels and decision points. And those are just a series of compound critical states where what's it going to do? I don't know. It could go up to the next one or down to the next one. And so if it goes long, you buy the breakout, you ratchet your stop. You don't believe in it except while it's there. I believe that the price is the price, but I don't have any insight to the black box that represents the collective intentions of the entire rest of the world in all its glory, expressing all of their competing ideas into this black box, which triggers decisions to buy and sell. I can't possibly know that. All I can do is know where the probabilities are from previous price action and how big those moves are and time of day and all that shit. And how is this symbol compared to the other symbols? So this is very much monitoring and managing the reactions of the herd to all the things that are coming out of the black box and the swamp and the jungle. You think that you could come up with some kind of math formula to the square times this plus this divided by 9 and plus that? You could come up with some magic formula that can predict that? You're nuts. All I can do is observe and respond. Like the carnivore that I am, watching the herd going to the watering hole to fill up and drink water. And I know how to pick out targets inside the herd that are easy pickings. And I know when I get them this way, the herd is going to run away from me because I'm a buyer. So maybe I spook them and I take some of my lions and put them over here. So when I spook them this way, they run right into the lions and they panic and go that way. Welcome to the Fed. All right, that's everything I got for today, pending your questions. Have a great rest of the day, guys. I'm going to go eat some organic eggs and ham. No carbs. Take good care. Very good question, Jonathan. I could give you a one sentence answer, but I think you can get that anyway. So
Thank
anyway,
you. I appreciate
yeah,
that.
the essay, yeah, the essay is there. It goes much greater detail for as much work on that as you want. Okay. Cheers. Take good care, guys.